Supply chain finance, SCF, is a set of financial practices and tools designed to optimize the management of capital and cash flow within a supply chain. It enhances the liquidity and efficiency of supply chains by leveraging the creditworthiness of larger buyers to offer better financing terms to suppliers. Here's a detailed overview of supply chain finance and its role in optimizing cash flow. Understanding supply chain finance. Supply chain finance, also known as supplier finance or reverse factoring, involves financial arrangements where a third-party financial institution provides early payments to suppliers on behalf of the buyer. This process helps suppliers receive payment faster while allowing buyers to extend their payment terms. Key components of supply chain finance. Buyer. The company purchasing goods or services. Typically, large organizations with strong credit ratings that create favorable financing conditions for suppliers. Supplier. The company providing goods or services. Smaller entities or vendors that benefit from early payment to improve their cash flow. Financial institution. A bank or a specialized SCF provider that facilitates early payment to suppliers based on the buyer's creditworthiness. How supply chain finance works. Invoice approval. The supplier delivers goods or services to the buyer and submits an invoice. Invoice submission. The buyer approves the invoice and confirms the amount due. Financing offer. The financial institution offers the supplier an option to receive early payment, typically at a discount. Early payment. If the supplier accepts, the financial institution pays the supplier the invoice amount minus a small fee. Payment by buyer. The buyer pays the full invoice amount to the financial institution at the invoice's due date, which can be extended beyond the supplier's original payment terms. Benefits of supply chain finance. Optimized cash flow for suppliers. Suppliers receive payment faster, improving their working capital and allowing them to reinvest in their operations or settle their own liabilities promptly. Extended payment terms for buyers. Buyers can negotiate longer payment terms without negatively impacting their supplier's cash flow, thereby optimizing their own working capital management. Reduced financing costs. Suppliers can access financing at lower costs compared to traditional borrowing options, as the financing is based on the buyer's creditworthiness, which is often stronger. Strengthened supplier relationships. Implementing SCF can improve relationships between buyers and suppliers by addressing liquidity needs and fostering a collaborative business environment. How supply chain finance optimizes cash flow. Accelerated receivables for suppliers. By getting paid sooner through SCF, suppliers can reduce their days sales outstanding, DSO, leading to a healthier cash flow and reduced need for short-term borrowing. Improved payables management for buyers. Buyers can extend their days payable outstanding, DPO, without straining supplier relationships, freeing up cash for other strategic uses. Enhanced working capital efficiency. Both buyers and suppliers can optimize their working capital cycles. Suppliers improve their liquidity while buyers maintain or even increase their cash reserves. Risk mitigation. Suppliers face lower risk of late payments or defaults, as the financial institution assumes the credit risk associated with the buyer. Practical example of supply chain finance. A multinational retailer implements a supply chain finance program. Supplier. A small electronics manufacturer. Buyer. The retailer. Financial institution. A global bank. The manufacturer delivers a batch of electronics to the retailer and submits a $100,000 invoice. The retailer approves the invoice and confirms payment due in 60 days. The bank offers the manufacturer an early payment of $98,000, 2% discount. The manufacturer accepts, receives the early payment, and improves its cash flow. On the 60th day, the retailer pays the full $100,000 to the bank, extending its payable terms without negatively impacting the supplier. Conclusion. Supply chain finance optimizes cash flow by providing early payments to suppliers while allowing buyers to extend their payment terms. This win-win solution improves liquidity for suppliers, enhances working capital efficiency for buyers, and strengthens overall supply chain relationships. As businesses continue to seek ways to improve financial health and operational efficiency, supply chain finance emerges as a valuable tool in modern financial management.